Hi, welcome to Coffee with Katie. Coffee with Katie is an initiative that I started to help simplify the financial conversation. I'm Katie Brown. I'm a certified financial planner, and I've had the privilege of working with families for nearly 20 years navigate their financial landscape. So, one of the things that I've learned over time is that it doesn't matter how much wealth you've accumulated, sometimes the fundamental conversation around investing is confusing. I decided to take a step back and do a 3-part series on investing basics. This is the first of that series where I'm going to talk about preparing for investing and why it's important to invest. Secondly, I'm going to talk about the types of investments. So that will be the next video. And then the third one is around asset allocation and ongoing maintenance. So let's dive into preparing to invest. I think it's important to first talk about why is it important to invest. One of the main reasons is to combat inflation. As prices of goods and services around us are increasing, if we're not doing something to increase the value of our dollar along with that, then we're actually losing money. So it's really important to keep pace with inflation and ideally exceed it. The second reason is to take advantage of compound interest. So the earlier you start, the more money you make, which can grow upon itself, that compounding effect. And for that, I thought I'd share an example with you. So let me pull this up. And here we're looking at a family. And if they were to start investing at age 45, 10% of their adjusted gross income each year. So in this case, the household's at $180,000. They're saving $1,500 per month up until their retirement age at age 65. So 20 years of that 10% savings. Overall, they've invested $360,000. If that's compounding at a 6% rate on a year-over-year basis, when they get to age 65, that's $693,000. Now let's look at that same family, fast forwarding 10 years. Maybe they didn't start investing at age 45, rather push it off to age 55. At this point, their household income has increased significantly to $360,000. They're saving 10% again, as in the first example. And so they've saved that total investment that they put in is the same as if they had started at age 45 at a lower amount, $360,000. But now we only have 10 years for that to grow and compound. So you can see a significant difference of about $200,000 between starting at age 45 and starting at age 55, even if you're putting in the same amount of money over the time period. Just a quick example there of a great reason why you want to take advantage of that compound interest. The third reason to start investing is to give yourself options because we don't know what's going to happen down the road. Maybe later down the road, you want to take a career pivot or change your residence or consider early retirement. If you're investing along the way, then that just gives you more options down the road. So you've decided you understand the reason for investing. Now let's talk about building the foundation for investing. And this is what I always say to my clients, once again, it doesn't matter how much wealth you've accumulated. You could have $5 million in your investment account. You want to make sure you have emergency reserves. That's the cash on hand that you can get to. And that level of emergency reserves may be different from family to family. There's a rule of thumb of 3 to 6 months, but it depends on how comfortable you are with that level. It also might depend on how steady your income flows are. So you might need more or less depending on that. But get your emergency reserves in place. The next thing is figuring out your investment goals and the time frame of when you're trying to reach those investment goals. And then thirdly, your risk tolerance. So your risk tolerance is really how much money are you willing to lose in an effort to make more money? So if you have $1 million in the account, is it okay if that goes down to 900,000 if you're down 10% with the chance of getting up to 1.2 million? Is that range comfortable for you, or does that need to be tightened up? So to understand what you can tolerate, and sometimes we don't learn that until the market becomes volatile. Then we really understand what our risk tolerance is. So that's the preparation for the beginning stages of why to invest and laying the foundation for investing. I hope you will join me for my next video talking about types of investments, and I also hope that you found this helpful. If you have any questions for me, please feel free to reach out. I would love to hear from you at kbrown@mortonbrownfw.com.